Investing can provide you with another source of income, fund your retirement, or even get you out of a financial jam. Above all, investing grows your wealth, helping you meet your financial goals and increasing your purchasing power over time. Or maybe you've recently sold your home or come into some money. It's a wise decision to let that money work for you. To enjoy a comfortable financial future, investing is absolutely essential for most people. As the economic fallout from the coronavirus pandemic demonstrated, a seemingly stable economy can be quickly turned on its head, leaving those who haven't prepared scrambling for income. So in today's video I will show you the top 10 investments that everyone should do. But before that, make sure to subscribe to us for more videos and tap the bell icon to get notified with every new video from us. So let's dive into the video. Number 10. High-yield savings accounts. A high-yield online savings account pays you interest on your cash balance. And just like a savings account earning pennies at your brick-and-mortar bank, high-yield online savings accounts are accessible vehicles for your cash. With fewer overhead costs, you can typically earn much higher interest rates at online banks. Plus, you can typically access the money by quickly transferring it to your primary bank or maybe even via an ATM. Savings accounts are best for short-term savings or money you need to access only occasionally. Think of an emergency or vacation fund. Transactions from a savings account are limited to 6 per month. Cash management accounts offer more flexibility and similar, or in some cases, higher interest rates. The banks that offer these accounts are FDIC insured, so you don't have to worry about losing your deposit. While high-yield savings accounts are considered safe investments, like CDs, you do run the risk of losing purchasing power over time due to inflation, if rates are too low. Number 9. Certificates of deposit. Certificates of deposit, or CDs, are issued by banks and generally offer a higher interest rate than savings accounts. And short-term CDs may be better options when you expect rates to rise, allowing you to reinvest at higher rates when the CD matures. These federally insured time deposits have specific maturity dates that can range from several weeks to several years. Because these are time deposits, you cannot withdraw the money for a specified period of time without penalty. A CD is for money you know you'll need at a fixed date in the future. Common term lengths are 1, 3 and 5 years, so if you're trying to safely grow your money for a specific purpose within a predetermined time frame, CDs could be a good option. It's important to note, though, that to get your money out of a CD early, you'll likely have to pay a fee. As with other types of investments, don't buy a CD with money you might need soon. Number 8. Money market funds. Money market mutual funds are an investment product, not to be confused with money market accounts, which are bank deposit accounts similar to savings accounts. When you invest in a money market fund, your money buys a collection of high-quality, short-term government, bank or corporate debt. Money you may need soon that you're willing to expose to a little more market risk. Investors also use money market funds to hold a portion of their portfolio in a safer investment than stocks, or as a holding pen for money earmarked for future investment. While money market funds are technically an investment, don't expect the higher returns, and higher risk, of other investments on this page. Money market fund growth is more akin to high-yield savings account yields. Number 7. Government bond funds. Government bond funds are mutual funds or ETFs that invest in debt securities issued by the U.S. government and its agencies. Like short-term CDs, short-term government bond funds don't expose you to much risk if interest rates rise, as they're expected to do in 2022. Bonds are known as a fixed income security. Government bonds are virtually a risk-free investment, as they're backed by the full faith and credit of the government. But in exchange for that safety, you won't see as high of a return with government bonds as other types of investments. The fixed income and lower volatility from bonds make them common with investors nearing or already in retirement, as these individuals may not have a long enough investment horizon to weather unexpected or severe market declines. Number 6. Corporate bonds. Corporate bonds operate in the same way as government bonds, only you're making a loan to a company, not a government. As such, these loans are not backed by the government, making them a riskier option. And if it's a high-yield bond, sometimes known as a junk bond, these can actually be substantially riskier, taking on a risk-return profile that more resembles stocks than bonds. Short-term corporate bond funds can be good for risk-averse investors who want a bit more yield than government bond funds. As is the case with other bond funds, short-term corporate bond funds are not FDIC insured. Investment-grade short-term bond funds often reward investors with higher returns than government and municipal bond funds. But the greater rewards come with added risk. Number 5. Dividend stock funds. Dividend stocks can provide the fixed income of bonds as well as the growth of individual stocks and stock funds. Dividends are regular cash payments companies pay to shareholders and are often associated with stable, profitable companies. While share prices of some dividend stocks may not rise as high or quickly as growth stage companies, they can be attractive to investors because of the dividends and stability they provide. Any investor, from first-timer to retiree, though there are specific types of dividend stocks that may be better depending on where you are in your investing journey. Young investors, for example, may do well to look into dividend growers, which are companies with a strong track record of consecutively increasing their dividends. These companies may not have high yields currently, but if their dividend growth keeps up, they could in the future. Over a long enough time frame, this can lead to returns that mirror those of growth stocks that don't pay dividends. Number 4. Index funds. Experts recommend low-cost, diversified index funds. These are funds with low expense ratios, or fees, that are great for all investors. An S&P 500 index fund is a great place to start. It tracks the top 500 companies on the stock market. Index funds are a safer investment than trying to choose individual stocks because they broaden your investments over hundreds of companies. This process works well if you don't have time or interest in picking individual stocks. Plus, over time this strategy tends to generate higher returns. There are several index funds to choose from, just take note of the fees and investment minimums. ETFs tend to be an easier entry point for beginners due to lower costs and minimums. Number 3. Investing in options. Options offer high rewards for investors trying to time the market. An investor who purchases options may purchase a stock or commodity equity at a specified price within a future date range. If the price of a security turns out to be not as desirable during the future dates as the investor originally predicted, the investor does not have to purchase or sell the option security. This form of investment is especially risky because it places time requirements on the purchase or sale of securities. Professional investors often discourage the practice of timing the market, and this is why options can be dangerous or rewarding. Number 2. Real estate. Traditional real estate investing involves buying a property and selling it later for a profit, or owning property and collecting rent as a form of fixed income. But there are several other, far more hands-off ways to invest in real estate. One common way is through real estate investment trusts, or REITs. These are companies that own income-generating properties, think malls, hotels, offices, etc., and offer regular dividend payments. Real estate crowdfunding platforms, which often pool investors' money to invest in real estate projects, have also risen in popularity in recent years. Investors who already have a healthy investment portfolio and are looking for further diversification, or are willing to take more risk to chase higher returns. Number 1. Cryptocurrency. Cryptocurrency is a kind of digital electronic-only currency that is intended to act as a medium of exchange. It's become popular in the last decade, with Bitcoin becoming the leading digital currency. Crypto has become a hot property in the last few years in particular, as dollars have flown into the asset, pushing up prices and drawing even more traders to the action. Bitcoin is the most widely available cryptocurrency, and its price fluctuates a lot, attracting many traders. For example, from a price below $10,000 a coin at the start of 2020, Bitcoin soared to around $30,000 at the start of 2021. Then it doubled above the $60,000 mark, before falling back. Cryptocurrency is good for risk-seeking investors who wouldn't mind if their investment goes to zero in exchange for the potential of much higher returns. It's not a good choice for risk-averse investors or those who need any kind of safe investment. Cryptocurrency has very significant risks, including ones that could turn any individual currency into a complete zero, such as being outlawed. Those are the top 10 investments that everyone should do. Hope you got some value. If so, make sure to subscribe to us for more videos and tap the bell icon to get notified with every new video from us. See you in the next video.